From New York City for our audience worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, the data in America leaving the Fed on the sidelines, a record-breaking week of debt issuance in Europe, and the biggest inflows ever into U.S. high-grade credit funds. We begin with the big issue, a middle-of-the-road payrolls report.
This report was mixed.
I think it's right down the middle.
Middle of the road.
Right down the middle of the fairway.
Different people are going to see different things in it.
But moderating, but still good economy.
Still pretty good, given where we are in the business cycle. Pretty solid report that still checks a lot of boxes.
This does not in any way change any expectations about economic prospects.
The trends have continued.
We are now where we were before the employment report in terms of those expectations.
Wage growth maybe is a little bit slower than what the expectations are, but it's still right around 3%, which is where we've been.
We are in an extended period of exceptional mediocrity.
An economy that's slowing gradually.
We're stuck in this world for the time being, and maybe that's not a bad world.
Joining around the table here in New York City, Priya Misra of TD Securities, George Rosenak of Wells Fargo, and Gershon Distenfeld of AllianceBernstein. Can we begin with that quote from a good friend of this program, Mike Collins? We're in a period of extended mediocrity. Are we, Priya?
Yes, so I think the labor report, was a little bit weak, but in our view, it's a lagging indicator. I'm still struck by the fact that aggregate income continues to decelerate. So if we're all hanging our hat on the consumer that's supposed to continue to spend, aggregate income is slowing. Where's the engine of growth? So we are in this mediocrity aspect, I hear you, but if there's no engine of growth, the Fed, I don't think this really changes the Fed. So the Fed is on hold. So we really need something here to boost growth. That's not coming from the labor market. And therefore, I think this year is going to be a little bit difficult. We're going to be in this narrow range. We all have to trade that range because this was not enough to move the needle. But it's not giving me a whole lot of comfort either.
Gershon, your take?
This comes on the heels of what was a gangbusters number last month, right?
Yeah.
Had it only been good last month, another good one, right? We kind of averaged it out. We'd all be feeling a lot better here. I think we have to get used to it. We're not going to get a whole lot of information from these payroll numbers going forward. If you look at either the medium term or the long term kind of rolling averages, we're 175 to 200,000 over any of those time periods, and that's enough. To create jobs for people entering the workforce, to spur consumption. It's not gangbusters. It's not, if you look at the hourly wages, they were a little bit weak on the margin. That's going to give the Fed comfort that we're not going to see inflation, going to put them on hold. But it is a ho-hum number.
George?
Yeah, I agree. The average hourly earnings number ticking down a little bit is something to just watch. Not something concerning right now. We're thinking it's more of a kind of a two-cubed environment, right? You get 2% growth, 2% inflation, and roughly 2% yields.
Keep hearing this.
You're going to have to trade in between those ranges. So you're not going to probably get too significant of a move.
Hearing variations of it anyway. We had Rick Reeder of BlackRock on the program this week as well, and he was saying that it's going to be 1.8%-ish inflation, GDP, on the 10-year as well. Does that resonate with you, Priya?
It does. I do think, there are a lot of risks out there. And the Treasury market should price in these risks. I think Treasuries right now are pricing in a Fed on hold, inflation kind of staying here, but not really pricing in all the risks. I mean, I would say business uncertainty. Just a week ago, we were dealing with US-Iran. There's still, the Middle East is still pretty unstable. We've got an impeachment, we've got an election. So I actually think Treasuries have room to rally. So I would say the 10s can get below 180, below 2%, because we've certainly taken out the hiking scenario. So there's a cap on the 10-year. And if any of these risks start increasing, I think Treasuries are actually an attractive risk hedge to any asset out there.
So our audience are fully informed, though. You also think the Fed comes back in at some point this year.
We do.
How does the Fed come back in it this year? Because pretty much everyone I speak to thinks the Fed is done on the sidelines and nothing brings them back in whatsoever.
So if you tell me that growth is indeed 2%, that there is absolutely no slowdown in growth, then I think the Fed is on the sidelines. Our view is that a combination of, slowing business investment, manufacturing is still pretty weak, that actually does affect the consumer through the course of the year. Plus, I'm really concerned that when the Fed stops buying treasuries, which I don't think is happening for the next 6 months, but at some point they're going to put enough reserves in the system and take a step back, that you get a tightening in financial conditions, where the market says, wow, this QE help to financial conditions is behind us. And at that point, does the Fed say that, look, we still don't see any inflation and we've actually seen the tightening, maybe we need to put in a little bit more accommodation. And there's no inflation fear, so what's the cost of adding some more accommodation? So we do think the Fed comes back in.
A couple of points to unpack then. The Fed comes comes back in. One, the second point, the balance sheet issue. Let's begin with one. Gershon, your view. The Fed could come back in at some point this year and think about cutting interest rates. Does that resonate with you in any way, shape or form?
Yeah, I think it does. And I think that's what the equity markets are banking on. Right? The equity, it's still, to us, it's the dichotomy between the two markets is still staggering. Right? Look, 2 weeks ago, was anyone talking about Iran? That wasn't on the list. We had a lot of the known things. We know what's going to be tomorrow. There are a lot of risks out there. Right? The Brexit's still unresolved, rising populism in the world. We can go on and on with the risks. Equities seem to be just taking it in stride. People are just, they're sitting there, they're comfortable. We're not going to have inflation. We're going to be low rates for a while. And people still think there's a Fed put. I think that we're still not sure how we're going to resolve this. You still look at manufacturing. You look at business confidence. It's not telling you the same thing as the employment numbers and consumption are telling you. History will tell you you're going to have one of those two kind of revert to some type of mean. Which one is it going to be? If we do start to see a trend where we get more ho-hum numbers on the employment side, we see consumption start to roll over, the Fed's going to come back into play. Should they is a different story, but clearly they're going to.
George? They want to be accommodative here, and they've been very clear about that. I think there's a huge hurdle for them to raise rates. To lower rates, though, don't think it's quite as huge. I think they want to use guidance. I think they want to remain on the sideline and just watch things as they go along. But I think right now, if they're given their druthers and if information declines at this point and starts going down, they're going to step in and start lowering rates.
I think many people agree with you all that the risks are skewed asymmetrically to cuts over hikes. What people will struggle with is trying to establish the threshold for a material reassessment of the outlook. And Priya, just a little downside surprise here and there doesn't, to me, translate as a material reassessment of the outlook. Are you saying we don't need a material reassessment, or are you saying that we will actually end up getting one at some point this year?
So our view is that you will get this material reassessment. I mean, it may not be material enough for a recession. I think what we've heard from the Fed is expansion of the recovery. You know, they've continued in the last few months. I think they've actually changed the reaction function here, because they're telling us that because they want to get inflation up to target and beyond, they're actually okay tolerating an overshoot. So any weakness in growth, so material is sort of subjective, but I would say if you get payroll growth closer to 100, I think they're going to be back in cutting rates.
George? Yeah, I think to your point, from a data perspective, you're right. They're going to allow inflation to run a little bit hot here. They want it, in fact. The challenge is, to your point earlier, if liquidity starts drying up, if they are running into that challenge, they might need to then do that. But the reaction function specifically is the markets themselves. They're going to be watching the markets dictate somewhat what they need to do going forward.
See, I actually don't think it's a catalyst as much as there are secular trends going on that are just going to end up slowing growth in the long term. You know, it's easy to point to President Trump as, being the cause of the trade war. There are bipartisan tendencies, not just in the U.S., around the world, much more protectionist, much more populism that, regardless of who wins in the White House in November of this year, there's going to be more volatility around trade. It's not only in the U.S. Australia, we're seeing it. We're seeing it in the U.K. It's not just about Brexit, right? There's a populism going on. There's more protectionist instincts around. That's going to put a damper on growth worldwide. Yeah. And at some point, it's going to slow growth. And central banks have, in our view, probably mistakenly think that their job is to control economies and to prevent downturns and recessions from ever happening. And the laws of economics haven't been repealed yet. There are still shocks. There are going to be cycles. They can't always save the day.
As you've pointed out, it's not about what they should or shouldn't do in this game. It's about what they will or won't do. You made 2 points, Priya. One was about the debate we're having at the moment over rates. The second point was about the balance sheet and the communication problem they could bump into in the middle of this year. Put all of that into all of that. The balance sheet operation around the conversation that we've just had in the last 5 minutes.
Right. So I think the Fed has been essentially injecting a lot of liquidity in the system to prevent another sort of repo spike. They have been very successful. So, we had been hoping for this. The fact that they put as much as $500 billion available actually allowed repo rates around year-end not to spike. But now what? Now what they have to do essentially is keep buying bills to offset these repo operations. The problem is, even though the Fed continues to tell us this is not QE, it looks like QE. They're actually injecting, reserves are growing, the balance sheet is growing. Our forecast is that they will be buying bills at $60 billion all the way up until the second half. So if it is June or July till when they're buying, the market loves that because there's more liquidity in the system. When the Fed steps back, I think they're a little bit in a trap. How do they take back that liquid or stop the liquidity injection? Because the market who thinks this is QE is going to say, wow, that's one form of injection that's gone, easing, and therefore financial conditions need to tighten. And I'm worried that that'll actually bring the Fed not to buy more bonds, but then they'll have to come into ease.
Given all of that, what do you think the biggest weight is sitting on top of real yields right now? From everything we've just discussed at the moment, what do you think it is?
I think it's a net supply issue. So net supply of treasuries, remember we were talking about deficits forever? We still have a lot of deficits. But last year, US Treasury debt to the private market was about $1 trillion. This year, we're estimating about $600 billion. So you have, even if I assume unchanged demand, no further increase in demand because of all the geopolitical risk, unchanged demand, but my supply of debt to the market is just 40% less, that's going to just keep real rates very low. It's good for risk assets as long as the economy stays okay.
Final word, George.
The technicals are definitely favoring fixed income right now, and I think that's very true. I think right now the market it's operating on liquidity, it's operating on optimism, and it's operating on momentum. It's not operating on fundamentals. That could happen for a short period of time or pretty prolonged period of time, but not for the long term, and that's going to have to turn around.
We'll carry this conversation over to the credit market. The guys around the table will be sticking with us. Coming up on the programme, the auction block, Europe's bond market wrapping up its biggest week on record. That conversation up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I'd like to head to the auction block now and begin right here in the United States in the Treasury market, where strong demand for the Treasury's $16 billion 30-year bond issue dispelled fears that spread after Wednesday's soft 10-year auction. In Europe's bond market, what a week. Wrapping up the biggest week ever with over $100 billion of new debt sales, underscoring its status as a major global funding vehicle. And the window wide open for risky energy companies here in the United States to rush back in. 7 companies offering high-yield debt this week alone. Sticking with high yield, Invesco's Tim Horsburgh weighing in on the big rally in credit markets.
If anything's going to go, it's going to be that lowest quality credit first. And seeing that rally over the last 3 months, really since that bottoming process in October, has been another good signal for us about the durability of this rally.
Back with me, Priya Misra, George Rusnak, Gershon Distafel. Gershon, that last line, the lower quality credit starting to rally, underscoring the durability of this market right now and the rally we've had. Your thoughts?
Well, this is what we talked about last month. High yield managers they're in a quandary. Last year was kind of free money. It was only the second time, 2005 being the other time, where high yield did well and triple C's didn't lead. It was double B's. You didn't have to take risk to get returns. And now you just do the math and realize that with double B's kind of yielding less than 4% today, right? That's not where you're going to get your returns. The only way to get them is through triple C's. However, most of the triple C's, or a lot of where the yield in the triple C's are in the energy space, where I think investors realize that a lot of these companies, even in the best of times, don't generate a lot of free cash flow. However, since we don't know where the price of oil is going to go, or at least rational people don't think they know where the price of oil is going to go, all right, who knows? What if we go to 80? These companies will be okay, at least for a while. So they're chasing things. And that's working so far. It's working in the short term. But the reality is that a lot of these companies, they don't work at $50 or $60 oil in the E&P space. And you're going to see a lot of restructurings unless we continue to see the price of the commodities climb.
You seem quite skeptical of the rally that we've had. We're back to the tights I don't think we've seen since 2014. The parallels between now and then, was that a stronger setup, technically speaking, the backdrop, the dispersion? What did that look like compared to what we have right now?
Yeah, the dispersion was a lot less. So what was generating that yield, you could get that yield without taking on an excessive amount of risk. In order to get the index yield today of closing in on 5%, you have to take a lot of risk. If you're not willing to buy a lot of those E&P companies and some of the other kind of distressed credits, you're talking about getting 4%. Back then, even if you avoided some of that kind of cuspy stuff, you could have gotten close to that 5%. That's just not the case today.
George, your take?
I think that the framework, like we talked about for the fixed income market, it's pretty strong from a technical perspective, right? You have roughly $500 billion less in supply that's going to be coming out this year, right? So from a global markets perspective, you see that. But I think specifically to high yield, what you're seeing there is a liquidity challenge, right? The liquidity challenge that we had back in September with the repo market coincided exactly when CCC started gapping out. And now all of a sudden they're figuring that out and CCC spreads are coming down. So they moved from 8.5% up to 10, and now they're back to 8.5%. Again, for us, it's not truly underlying fundamentals that are improving. It's just some of these technical factors. And I think over the long haul, that's going to be a tough thing for them to work through.
Priya.
Just from a macro standpoint, I would say, I would completely agree. I think fundamentals are telling you that there should be more dispersion. I think we should be looking at the credit of these companies a lot more. But you look at how tight these spreads are, and that just tells me reach for yield is dominating everything else. The fact that there aren't even enough treasuries, people are looking for yield elsewhere. But I just worry the first sign of either default risk picking up, downgrades picking up, I think it makes certain sectors of the credit market extremely vulnerable. So either you have to be smart and get out early, or you have to hedge that with duration.
This theme that there's not enough debt, does that carry over to some of the dynamics we're seeing in Europe at the moment, where we've had a record week of issuance, but there's a belief that we'll be starved of that supply as the year grows older? Is that a dynamic you're thinking about, Priya?
Yes, it is, because particularly for Europe, the ECB is doing QE, so they are taking paper out of the market, and on a net basis, the numbers are not that high in terms of net issuance. So I think this global reach for safe bonds, or even not so safe but high positive yielding bonds, I think is still out there.
George?
But it's the other side of the equation too, right? So it's not only the supply is down, but the demand is up dramatically, right? The demand for corporate debt domestically here, the demand for even munis was record year last year of inflows, and you're seeing that across. And I think that's the thing that you're going to see right now actually play out as institutions start getting demand, right? You're getting a lot of pensions and you're getting a lot of pensions moving into the point where they have to move from their equity exposure, that the gains that they've had, into fixed income. So you're going to see flows that way. Individuals 65 plus, we're seeing flows in that way. So from a both supply standpoint and a demand standpoint, it's really favoring moving into fixed
What's the
income
biggest driver of those inflows we've seen into high-grade credit funds in the United States? A record week of inflows. What's the biggest driver behind that?
It's a combination of the institutional side, but the individual side, I'm telling you, 65 plus, it's talking about 1.3 trillion a year for the next 10 years is going to be flowing from individuals in that. And we're definitely hearing that from our clients right now, starving for income.
Gershon?
This is why active management is here to stay in fixed income. We're just great at chasing what the theme was in a previous period that we were dead wrong on. So 3 months ago, no one would touch an energy bond. Now people can't get enough of it. 6 months ago or 9 months ago, the story was, oh my God, triple Bs, they're all going to get downgraded. We won't touch those. Now people can't get enough of them. So there are opportunities to go against the grain. That's what we try and do. We don't always do it 100% successfully, but that's what active management does in fixed income. As it relates to IG, people are somewhat chasing it. People do need yield. The one thing that we're hearing from our clients outside the United States, you talk to, both European investors and especially Japanese investors, the cost to hedge has come down somewhat. It still is somewhat costly relative to history, but since the Fed has cut a number of times now, the cost to hedge back to the home currency, whether it's the euro or the yen, has come down. It is making a lot of investors have been on the sidelines for the past 2 or 3 years. They're starting to come back a little bit.
I want to pick up one point that you made just to wrap up this conversation. Going against the grain. What is going against the grain in 2020? What's the contrarian call within fixed income, within credit at the moment? What is that trade? As you said, coming into 2019, everybody hated this triple B story, especially those of us who were outside of fixed income looking in, saying that looks like a scary place. Fantastic year. What is the triple Bs of 2020?
Well, I think one is chasing the weaker E&P credits, we think is a very big mistake. Now, how can we be wrong on that? If oil goes to 80 or 85, we'll be wrong on that. But again, that's not something. That's some probability of that.
What about something like loans? What about leveraged loans?
Well, I think leveraged loans actually looks more interesting to us than they have been in quite some time. As we've, for 10 years we were negative on it. We actually have more exposure in our portfolios today than we've had in some time. I wouldn't say it's the greatest opportunities in sliced bread, but some better opportunities than we've seen.
The guys around the table will be sticking with us. Still ahead, the final spread. The week ahead featuring a big gathering at the White House. The US and China preparing to sign phase 1 of the trade deal in Washington, D.C. That's coming up. That's next. This is Bloomberg Real Yield. Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, a ton of Fed speakers, slew of Fed presidents, including Eric Rosengren and Esther George. They'll be giving their outlooks for the U.S. economy. The big banks kicking off earnings season on Tuesday. Plus, we get U.S. CPI data. And then the big event coming on Wednesday. United States and China scheduled to sign the first phase of their trade deal at the White House. For some final thoughts, Priya Misra, George Rosnak, Gershon Distenfeld still with me. I want to pick up on a quote from Gershon that was sent over to me because I think it's really interesting. When you have yields as low as they are right now, people will be thinking about where do I get my returns, where do I get my income in fixed income. You pointed out the following stat, and I want to read it to our audience. The 10-year Japanese government bond began the last 3 years with a yield near zero, and 11 of the last 12 years with a yield below 1%, but annual returns over this period averaged more than 2%. Just how important is that kind of dynamic in a market like the one we've got at the moment?
Well, I think people, for most of that time, yield curves were fairly steep, so you get rolled down, right? As bonds get shorter in maturity, they trade at lower yields. You can capture that. Curves aren't nearly as steep today, so that's not as big a phenomenon. But the reality is, right, yield doesn't necessarily equal total return on fixed income. That's something that I think investors don't always appreciate. But right, the main reason that you want to own high-quality fixed income is to serve as an offset to the risk part of your portfolio, so whether it's equities or other assets. And you want to make sure, we forget pretty quickly. Yes, we had a 30% return in the S&P last year, but we had a 20% drawdown towards the end of 2018. That's going to happen again at some point. You're going to want to continue to have duration in your portfolios.
Quick word, George.
We do think that moving out the curve is actually a pretty good move at this point. We've actually are now favorable on the intermediate part of the curve. Don't want to go too far out, but again, the concept of total return versus just true yield is an important one to have a conversation with clients. Unfortunately, sometimes they're not as accepting of that conversation.
I want to get to the rapid fire round with you all now, guys, and whip through 3 quick questions and get 3 quick answers if I can. And Gershon typically is a little bit troublesome on this particular segment, so I've left a little bit more time to do it. The 2% inflation, 2% GDP, 2% US 10-year dynamic, is it realistic or wishful thinking? Realistic or wishful thinking? Priya.
Wishful thinking.
George.
Realistic.
Gershon.
I don't even know what the question means, but wishful thinking.
A rally in triple C's, does it underline the complacency or highlight the durability of the high yield rally? Underline the complacency or highlight the durability of the rally? Priya.
Complacency.
Gershon.
Complacency.
George.
Complacency.
And finally, the rally, the record supply in Europe that we've seen. Can the market take it, or is indigestion brewing? Can the market take the supply, or is indigestion brewing? George.
I think you can take it.
Gershon.
Take it.
Priya.
I think you can take it for now.
Guys, really thoughtful stuff as always. A special thanks to Priya Misra, Gershon Distenfeld and George Rosnak as well. From New York, that does it for us. We'll see you next Friday at 1 p.m. New York time, 6 p.m. in London. For our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.